I'm Emerald Lagasse. Check out my OnlyFans. Bam! Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of August 23rd, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. That week in the market was pretty heinous for the first 2 days. Monday, Tuesday, Wednesday, we had drops market-wide before there was a bit of a recovery on the second half of Thursday and into Friday. But still, we were at a net loss on the S&P 500, the NASDAQ, the Dow Jones. They were closing slightly below where they opened the week, and the Russell 2000 just keeps bleeding investment dollars. And if you have anything that's in the Russell 2000, man, it sucks just watching it go down again and again, week after week. I hate it. I guess that's part of investing. You can't enjoy the highs if you don't deal with the lows. Changing up the format a little bit of my videos, the weekly news videos are going to become much shorter. I'm going to be cutting out the options section for watchability, and since I have more time to put out more videos, I'll be putting out a separate video each week with options. That being said, probably no options this week, but there is another video that I will be making this week with updates on some of the investment videos that I have made in the past, so keep an eye out for that one. More videos coming, just shorter videos overall, which is probably a good thing since my average view duration is only like 18 minutes and my videos are like 30 plus minutes. Yeah, I'm kind of losing out on some viewers there, so I'm going to try to get that number up. A couple of news stories that I'm not going to cover fully in the video, just some headlines this week. You had the big Michael Burry versus Cathie Wood thing, the he said, she said, the coming out in public, and I mean, it was just blown out of proportion by FinTwit and all that jazz, but Burry's fund, Scion, ended up taking a short position against ARKK, but it's only like 1.5% of his portfolio, and it's just a hedge. And it was like blown up like it was some huge thing, but keep in mind, Burry's still long on most of his positions. It was just this was a short hedge on something that he feels is overvalued at the moment. And Cathie Wood came out and ended up making a statement that Michael Burry doesn't understand tech valuation, innovation valuation. Oh, burn. I mean, either way, it was just drama. He said, she said, I don't really care that much about it, but a lot of people were talking about it, so there you go. That's the extent of it. It's nothing. Also, last week I mentioned getting puts on Krispy Kreme DNUT before earnings. I didn't end up doing it. I wasn't feeling too comfortable with the options prices pre-market on Monday, but of course, had I done it, I would have made money because leading into earnings, which is probably when I would have sold them, the put value did go up. It dropped off along with the rest of the wider market Monday, Tuesday, Wednesday, before there was a bit of a recovery Thursday and Friday off of really just mixed earnings. I don't understand how some companies like Shift last week, like Pubmatic last week, can have great earnings and then the share price drops off. Krispy Kreme has meh earnings and then the share price jumps up. And it was a big jump too. It was like a $2 jump. So I don't really understand that one, but hey, it's the stock market. Also, Pershing Square Taunton Holdings, Bill Ackman put out some PR that was not great if you're a PSTH holder, and I don't really have a good way to sugarcoat this. He's basically saying the company is facing some litigation, a class action lawsuit. He's not sure how quickly it can get resolved. The tone of the letter made it feel like there's a chance that there's not going to be enough time to actually find a merger because no company is going to want to merge with them while the litigation is hanging in the air. I'm going to talk more about this on my other video later this week, but this is kind of a devastating blow, and I can't really think of a positive spin on this one, but I'll talk more about that later. For now, let's get into the news. Let's start out with a bit of a feel-good story this week. More Americans have $1 million saved for retirement than ever before. 401k balances are at a record high. Now, this is obviously incredible news, and I am so happy that people are investing. This article went on to talk about the positives, the negatives. It was an opinion piece, but in my mind, this is a net positive. You know, we've seen a surge in retail investors on platforms like Robinhood, and we've seen numbers coming out of TD Ameritrade and Fidelity and Charles Schwab that there's record numbers of people signing up and creating investment accounts. And I am so happy about this because something I'm very passionate about, it's not just financial literacy, but also financial responsibility and taking control of your own finances. So the fact that there are more millionaires than ever in America as far as retirement accounts go. This is really awesome. This is great news, and I'm so happy about this. And then obviously somebody's going to be like, but wait, Walrus, inflation, $1 million isn't what it used to be. Yeah, I mean, yeah, that's right. Okay, $1 million isn't what it's used to be, but this is at least a step in the right direction. I can't think of a single way that anybody could spin this negatively. This is fantastic. Good job investing, people. Yeah. One thing about the article, though, is that it was talking about how people are not taking advantage of their employer's 401k matching. Guys, if your employer offers 401k matching, freaking do it. There's no downside. It's quite literally free money. When I hear about people being offered 401k matching at work and then not taking advantage of it, I mean, just what are you doing? Do you not like money? Do you not like it when people just give you money and double your investment? Oh my gosh, people are dumb sometimes. Seriously though, if you're one of my viewers and you have a 401k matching plan offered at work, take advantage of it. Please look into the details, take advantage of it. Even if it's just limited ETFs or stocks or bonds, it doesn't matter. Whatever it is, take advantage of that to the max. Now, this is a story that a lot of people probably just glossed over. Mastercard faces a $14 billion class action lawsuit in Britain, and I'm going to show you why this is actually a huge deal. A UK court has approved a $14 billion class action lawsuit against financial services corporation Mastercard for overcharging fees to millions of British consumers using credit cards for payments. Britain's first mass consumer class action suit with 46 million claimants was brought by former financial ombudsman Walter Merricks to the Competition Appeal Tribunal, which formally approved it to proceed to trial. The case will be probed under the Consumer Rights Act of 2015, which entitles claimants, both consumers and small businesses, to compensation for Mastercard's alleged anti-competitive behavior. Surprise, surprise, we have a legacy credit card company overcharging people for fees, unfairly charging people for fees, and there's now a class action lawsuit being brought against them. Is anybody surprised about this? No, absolutely not. This is one of the reasons that DeFi should be the future. DeFi is gaining popularity. Decentralized finance is absolutely what we need, and I know Mastercard is not necessarily part of the central banking system. It is a payment processor, but because it's a legacy, because it's been around for so long, Mastercard does have a lot of the same purchasing power as banks and a lot of the same influence as banks. And man, I cannot wait for adoption of DeFi to be higher because this sucks. But not only does it suck, this is actually huge for Mastercard. If this lawsuit is lost by Mastercard, their financials don't look good enough to be able to support that without it affecting them for years to come. Here's Mastercard's stock price. You can see it's been dropping off a bit since their last earnings report. We were at around $387. We're around $355 right now. That's not too important. I want to go to their balance sheet. Mastercard only has about $6.22 billion in cash and cash equivalents. Their total assets overall are about $35 billion, give or take, and their total liabilities are around $28 billion, give or take. We've only got about $6.22 billion in cash and cash equivalents. On the income statement, the revenue is about $4.5 billion, which is an increase, which is great, but the net income is only $2.07 billion. While these numbers are pretty good for Mastercard, you can see quite well that with $6+ billion in cash and cash equivalents on hand and net income of about $2 billion a quarter, a $14 billion fine would be devastating for the company's growth. That's something that you end up dealing with for over a year, probably over 2 years, trying to minimize the losses, mitigate the payment. They would actually probably have to get financing just to pay that fine and then pay back the financing with interest, so it'd end up being higher. I mean, this is a bad situation for Mastercard. I'm obviously not a lawyer. I haven't looked at the details of the suit, but this seems like something that could possibly be applied to other financial companies, other payment processors, and I bet everybody is going to be like looking into their legal issues, talking to their local ombudsmans and figuring out, are we in danger here? Could this affect us? Because, I mean, Mastercard this sucks. And here is my favorite story of the week. OnlyFans is banning sexually explicit content. I am completely aware that OnlyFans is not a publicly traded company, but the company did seek valuation recently, and there were some rumors that they might be going public. They're looking for additional private investors, people that want to invest into the growing company that's about, I think, 5 years old now. It was started in the UK. OnlyFans is something that really a couple months ago I regarded as one of the possible tech unicorns because of the growth rate of the user base since the pandemic and the likelihood, the stickiness of that user base. Disgusting. Stickiness. I should have picked a better word there. I mean, the fact that their user base is not going anywhere, and once somebody signs up, they're likely to stay on OnlyFans because of the subscription nature of the platform. Without reading the article to you guys, the entire premise here for the OnlyFans article is that OnlyFans was getting pressured from some of its payment providers about the fact that it deals so much with sexually explicit content, and the payment providers, they're being lambasted, described as puritanical and whatnot, but basically they just don't want to condone the behavior on the OnlyFans platform. So, starting in October, sexually explicit content is going to be banned. Now, nudity will still be allowed, lingerie will still be allowed, but you'll have no more, you know, butt stuff or intercourse or whatever goes on OnlyFans. And the company went as far as saying that they wanted the platform to kind of change directions and become a platform for content creators of a non-sexual nature to come together and share their skills. And they were talking about like people sharing cooking tips on OnlyFans and people sharing art on OnlyFans. And oh my gosh, this is just, it's almost like the company is trying to blow itself up internally. Like that's the biggest 180 in a business model. This is like when Tumblr banned porn. What happened to Tumblr after it banned porn? Nobody uses Tumblr, the user base is gone, everybody moved on. So OnlyFans doing this, I mean, that's what the brand is known for. Nobody is going to associate OnlyFans with art, or nobody is going to associate OnlyFans with cooking. This is like McDonald's taking hamburgers off their menu. And like you go to McDonald's, order a hamburger, and they're like, oh no, I'm sorry, we only sell filet of fish now. Come on, you know what people are there for. I'm imagining trying to rebrand the OnlyFans image. Imagine they get Emerald Lagasse on and like he's trying to talk to people about how to prevent a souffle from collapsing. I'm Emerald Lagasse. Check out my OnlyFans. Bam! Can you imagine his OnlyFans? He takes off his shirt. Bam! Takes off his pants. Bam! Oh man, that would just be frightening. That would absolutely be frightening. I don't know why I'm saying Emerald Lagasse is going to be doing a striptease on OnlyFans, but that's not going to happen. That's not going to happen. Funny, or maybe not funny, I guess, depending on how you look at it. I wonder how many people are going to be suddenly unemployed when OnlyFans bans sexually explicit content. I wonder if the Department of Labor is going to include that on the job statistics. Probably not. In other gig work related news, court rules California gig worker initiative is unconstitutional. Gig economy companies, including Uber, Lyft, DoorDash, and Instacart, were pushing to keep drivers independent contractor status, albeit with additional benefits. The ballot measure was meant to cement app-based food delivery and ride-hail driver status as independent contractors, not employees. Here is the bulk of it right here. A California judge on Friday ruled the 2020 ballot measure that exempted rideshare and food delivery drivers from a state labor law is unconstitutional, and it infringed on the legislature's power to set standards at the workplace. Once again, you guys know how much I hate Uber and how much I hate Lyft and how much I hate these companies, these rideshare companies that absolutely take advantage of people and pay them not nearly enough for the wear and tear on the vehicles and the amount of time they put in. And a couple months ago, when the UK ended up fining Uber, I think it was the city of London ended up fining Uber for similar practices, saying that they couldn't treat their drivers as independent contractors. I mean, we saw that already in the UK, and here it is happening in the largest state in America, California. You know, I really feel like this kind of signs the death warrant of Uber and Lyft and DoorDash. I mean, it's not like DoorDash made any money ever, but you could really see how this is just not going to work. Their entire business model is predatory, and it banks on the fact that they don't have to pay many benefits for their drivers. Yes, they offer some, but not many, not enough. So this is really going to hurt their business model. It's going to hurt their bottom line. Most of these companies, in fact, all of these companies are not profitable. So now they're going to have to be paying out more money to their employees. Don't really see this one working out. Puts on Uber. If you check out the Uber chart, we've actually been in a really, really strong downturn for a while now. Basically going back to the February peak, we've been riding all the way down. We're at the lowest point in a very, very long time here on Uber. Have to go back to 2020. It's just leading downward. And the weird thing is this story about the California law ended up breaking after hours, after market close on Friday. So on Monday morning, I would fully expect Uber to drop even lower, pretty drastically, probably in the pre-market. And Lyft and DoorDash are going to be in the same boat. It's not like I'm just picking on Uber because I hate them most, but you get the idea. All of these companies are just going to probably get hit Monday pre-market really hard. This is another fun one from MarketWatch. Nearly 6 in 10 Gen Z investors and 9% of baby boomers admit to trading while drunk. According to a new survey from consumer finance website Magnify Money, 32% of US investors say they have made trades while drunk. This can be combined with the rise in emotionally charged investing that traders say they would later regret. Raise your hand if you're surprised about this one. No? Nobody's surprised? Yeah, me neither. Actually, I'm one of the drunk traders. I mean, I think that probably falls in the fact that my market hours, my trading hours are in the evening because I live in Korea. So I tend to have a beer or two before I do my trading at night. I don't get drunk, but I do get buzzed and I just take the edge off. Little relaxation for the trading hours. But I mean, here we're talking about like what? Day drinkers? Drunk day drinkers in America? I'm just imagining people like sitting on their couch in a stained t-shirt and underwear with like a bottle of Cab Sauv and their Robinhood app, and they're just like going to town and chugging the bottle. I don't know if that's what's happening, but that's the picture that this article is painting here in my mind. And a lot of this is kind of blamed on the gamification of stock trading. The fact that there's a lot of services now that offer free of commission stock trades. It's easier to get in and out of positions. Personally, I think that's good for retail investors if it's used responsibly. But also we have platforms like Robinhood that add the fun graphics and colors and make stock trading seem like a game. I'm not crucifying Robinhood for that. People are adults. They should know what they're getting into. But, you know, maybe trading drunk is why Robinhood ended up opening on IPO at 38. Just a couple days later, we touched 85 and we're already back down to 42. I have to imagine there were some drunk trades involved with Robinhood's rise up to 85 because that platform sucks. Now, if you trade drunk, I'm not telling you not to do that. It's kind of fun. Just be responsible, and maybe you should avoid 0 data expiration options if you're a little bit inebriated, you know, because those are the ones that can kind of blow up your account. Just trade responsibly. I feel like the Dos Equis guy right now. Trade responsibly. I'm actually going to say something positive about China. Stop the presses, freeze frame this moment. I think I've been a huge bear on China for the entire length of my channel, but really these valuations for these Chinese companies are getting absurdly low. Even after a $1.5 trillion rout, China tech traders see more pain. Even a $1.5 trillion sell-off may not provide an attractive entry point for equity investors as they grapple with cascading risks in China's technology sector. A stock rout triggered by Beijing's widening clampdown has left Tencent Holdings trading at price-to-book ratio lower than the 2008 financial crisis. Alibaba has slumped to a record low in Hong Kong. And really, this is just all Chinese stocks. If we take a look at HXC, which is a market cap weighted fund for the NASDAQ Golden Dragon China Index, go back 5 years. We've actually reset ourselves right now to just after the COVID drop or just below the COVID drop, depending on how you want to look at it. So we've actually gone a year and a half, almost 2 years back with the current prices of the Chinese stock market. This is an incredible sell-off. Now, if we go year to date on Alibaba, we can see back in February, the middle of February, we hit 274.29. Right now, Baba's sitting at 155.50. This is really an insane drop-off. That's almost a 50% loss in Alibaba. Baidu, which is the other Chinese company that I actually really think is a strong company. Back in the middle of February, we hit a high of 354.82, and right now we're sitting at 135.89. This one has ended up dropping like 67% in just a couple of months. And remember, Baidu's the company with something like 700 or 900 patents in like AI. Now, you guys know I don't like Chinese companies, and you know why these companies are dropping right now. The Chinese government controls the market even more so than most people thought, I believe. The things that they're doing, they're tightening regulations, restrictions on tech companies specifically. A lot of this started with Alibaba at the end of last year with the Ant IPO being blocked for antitrust reasons. Then we had Didi ignoring the Chinese government before its IPO and not dealing with the things that the government wanted them to fix. And now I feel like the Chinese party is just taking out their frustrations on all of the tech companies as a whole. And you're seeing these sector-wide declines, these massive declines, and it's setting back company valuations a decade. It's absolutely crazy. And, you know, I don't like Chinese companies because they don't allow third-party auditors auditing and you don't exactly know what's going on. So I would typically stick with the bigger companies, but it's starting to get to the point where there's so many value opportunities. Baidu and Baba just released their earnings reports. Go check them out. I'm not going to go through them now, but they were incredible. These companies, like Baidu's a growth company and their revenue was astounding. Their net income wasn't great, but for a growth company, that's expected. Baba's just bringing in money and they dealt with the fine like it didn't even happen. The companies are growing, the companies are strong, and just their valuations are getting tanked for reasons that are outside their control. So if you want to open a position in the Chinese companies, really you have to ask yourself, are you willing to wait for everything to settle with the Chinese party? Are you going to try to time the bottom? We don't really know what's going on, but you know, the further these drop, the more I actually want to invest in these companies because, you know, at the end of the day, a company is a company, a business is a business. They make money, they make investors money. So I don't think China wants their stock market to completely fail. They still want the income from international investors coming into the country. And I can't imagine this is going to go on much longer. A little bit of doom and gloom news really quickly. Palantir bought $50 million in gold bars in August as cash pile grows. The data analytics software maker had a growing cash pile thanks to stock sales, and now it's investing in growth as well as early stage customers. It's possible Palantir could also invest in crypto. And while some companies such as Tesla are investing into Bitcoin, data analytics software company Palantir is betting on gold. Palantir bought $50 million in gold bars in August, the company disclosed in its latest earnings statement. The reason I say this is doom and gloom, it's not because one company is investing into gold, which is typically a slow-moving asset. It's a store of value. When you expect bad things to happen in the economy, you buy gold. But it's the fact that Palantir is a data analytics company doing this. You know, remember, this is the same company that helped the US government track Osama bin Laden to the exact cave in Afghanistan where he was hiding. I mean, if Palantir is capable of picking a cave that a guy is hiding in a massive country, I'm pretty sure they know what they're doing, and at least the probability in their software is indicating that something bad is going to be happening to the US economy. So when I see a data analytics company like Palantir doing something like this, this carries more weight for a potential bear market in the near future than anything else I've seen, quite honestly. And I know that may seem like I'm putting a lot of faith in Palantir, but come on, writing's on the wall. These guys are good at what they do. They analyze data, and this is what they're determining is the most prudent course of action for their money. And earlier this year, we actually saw gold prices rise over $2,000 for the first time ever. So gold is high right now and they're still buying in on it. Let's take a look at the upcoming earnings for this week. We actually have a lot of Chinese companies coming this week, the biggest of which is JD.com, which is another e-commerce company. JD.com has actually fallen pretty far, just like Baba. I think JD.com is down from February about 35 or 40% off of its highs. So it's really in the same boat. A lot of the e-commerce sellers were falling off proportionate to each other. We have a lot of US retailers reporting. We got some sports stores, Dick's, Hibbett Sports. We have a lot of smaller retailers like Express, Ulta, Abercrombie, Gap, some dollar stores here, Dollar General, Dollar Tree. By the way, these are fantastic investments, Dollar General, Dollar Tree. With the disappearance of the middle class and the rise of the lower class, Dollar General, Dollar Tree are going to be around forever. And their real estate portfolio is astounding. So if you are looking for like a consumer staple investment / retailer, check out Dollar General, Dollar Tree. Really, it's worth your time. And they actually pay out some dividends too. Not great, but they do pay them out. We've got a lot of cloud computing companies coming up this week. I think Box is cloud. Pure Storage, I'm pretty sure, is cloud. There's a lot of tech companies here towards the end of the week. And we've got Momo, which is a Chinese social media app. Their user base has been growing, but their financials are looking a little rough, and China's been hit pretty hard for the tech sector. But really, I just want to kind of profile Viomi. Viomi is a Chinese company that I've been following for a long time, and I'm not doing a 180 overnight and suddenly I'm in love with Chinese companies. That's not really the way that I work. I've had this long-standing distrust of them for their financials, but Viomi's been something that's on my radar for a long time. I see their products in Korea a lot. They sell IoT products for your home, like robotic vacuums, like the Roomba, basically, except their own version. They sell water purification systems, air purification systems, which it's a really big deal in China with the air pollution levels. And they also sell cordless cordless vacuums, basically home electronics appliances, small electronics appliances, and a lot of their patents are in AI, in IoT, and in 5G technology for the home, for interconnectivity. And I think Viomi's patent portfolio is worth more than people are giving it credit for. Here's their website, 5G IoT at home. You can see their products here, a lot of vacuums, water appliances, air purifiers. You know, it's nothing that's super exciting, but here you've got their 900 plus patents, industrial design awards, different appliances, a lot of homes globally using their products, not just in China. And you've got a company here that's sitting at a market cap of $348 million. So this is a small cap company. It's a Chinese company. But if we look at their financials, their revenue for one quarter is coming in at $191 million. Their market cap is $348 million. I know revenue's not the entire story. Net income is. And for the record, their net income is positive. I think last quarter it was around $7.5 million. So it's not great, but it is positive. But you've got a company here that has a quarterly revenue that's like 60% of their market cap. You know, this is really an incredibly undervalued company as it stands right now. Their PE ratio is about 6.82, which is really low for a tech company, for a future tech company. This just seems like a buy, other than the fact that it's a Chinese company, other than the fact that Chinese companies, you don't actually own the stock, you're investing in a shell company, other than the fact that the Chinese government could just flip a switch at any moment and wreck the entire economy. You know, throwing those huge obstacles out the window, this really does look like a bit of a value play. Now, there are no options available for Viomi. You could see the stock price right now, you know, we're trading right around where we were going back into 2020, and before that, we're actually low. The low that we hit was 420 here on the COVID drop. That's the pot number. And we went as high as 1899 here in the February run-up when everything was going crazy. Right now, we're back down to 482. RSI is really oversold. MACD is super low. And this just looks like a pretty solid opportunity for a value investor that's willing to take a chance. Now, I'm not saying go out and buy Viomi. You know, everything on here is just my own personal opinion. But as I'm seeing these valuations for these Chinese tech companies dropping more and more, it's getting harder to fight the urge to buy them. These companies feel like their valuations are becoming sinfully low. You know, I'm curious in the comments section this week, let me know what you guys think about the Chinese companies. Are you thinking what I'm thinking and it's starting to look like, you know, it's an opportunity that's too good to pass up? Or are you still just staying away from them because of the shell company nature of Chinese investments, or what? I mean, I'm curious what you're thinking, because I know all the negatives and I'm still really having a hard time fighting the urge to buy into these companies right now. That's it for me today. I'm going to have some more videos coming for you guys later this week. I do hope you tune in for that content. As always, if you enjoy the channel, please check out my Webull referral link below the video. Seriously, check it out. Webull runs some really awesome promotions. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Webull's the app that I'm using in my videos to do the financial analysis, technical analysis, all of my charts. I love the layout. All the information's fantastic. Also, if you like the video today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Have a great week. Good luck investing. I hope this week treats you better than last week. See you in a couple days.